For more on the U.S. economy, we welcome back Daniil Manaenkov. He's the head of U.S. forecasting at the University of Michigan's Research Seminar in Quantitative Economics. That is a mouthful, and that means you're really smart, I assume. We saw that the latest Fed minutes show that inflation is still on its way up, but it seems like the market's taking this in stride. What's going on?
Thanks for having me, Phil. To be honest, the minutes released today did not add that much information. We basically got a glimpse of what the Fed thought 3 weeks ago. And since then, recession worries have sort of occupied a lot of the Wall Street hive mind. And today, we basically saw that the Fed was not expecting any kind of recession in the near term. And they were pretty hawkish on inflation. They were planning to watch and planning to act aggressively. But since then, in the last 3 weeks, a lot of macroeconomic data was a little bit weaker than expected, and all of that adds up to rising recession worries. And if you look at the expectations of what the Fed is what the market thinks the Fed will do, the expected path of the future funds rate has slid quite considerably over the last 3 weeks. So I'm not exactly sure that the report that we saw today is adding much to the understanding of what the Fed is going to do. We know that they'll be aggressive if inflation keeps rising, but whether it will keep on increasing or staying elevated is a big question right now.
Yeah, we know that the consumers obviously have been battling this inflation issue. Gas prices have kind of tipped back a little bit. I've seen a number of data points that show that the economy, at least from a macro perspective, have sort of eased, if you will, that pressure. And perhaps that's causing some people to be more confident that the worst might be over. And I don't know if your statistics are showing that as well.
So there are not many real-time statistics. So what we are seeing is typically has some lag. So it'll take a little bit of time, but some highly watched real-time estimates, so such as the Federal Reserve Bank of St. Louis nowcast of the second quarter GDP has turned decidedly negative in the second quarter, and that's what's spooking a lot of people. I think the jury is still out whether we're going to see a contraction of GDP in the second quarter. And if we do see one, I think it will be more of a coincidental. So maybe inventory will be a drag on growth, but we're probably going to see consumption that will continue growing. And the big report that's coming out this Friday has the power to reshape a lot of minds, because what is happening in the jobs market is basically the single best indicator of what's happening in the economy, and it's one of the timeliest reports that we have. So on Friday, there could be some market-moving news.
Right.
If the report is not what expected.
And I'll tie that into consumer confidence and consumer spending. I mean, that's obviously a huge part of the economy. Do we have any statistics as to how the consumer is being impacted with the recent rise in rates?
So, I mean, we know mechanically how much more expensive mortgages are compared to, say, even beginning of the year, and that's quite spectacular. I mean, if you were to finance a median price home today, it'd probably be 30–40% more per month on the mortgage. But the latest blip, the latest data on new home sales actually poked up, which was surprising. The latest declines in the price of gasoline, which were modest compared to what happened to the price of oil, mean that in the near term, they may be a little bit of an extra breathing room for the consumer to keep spending, especially if gasoline prices realign better with the 20% correction that we have seen in the price of oil over the last 2 to 3 weeks. So I think in the near term, the economy still can keep on growing. What happens by the end of the year is still a big unknown, and that's what the market is typically most sensitive to.
Yeah, Daniil, I'm curious to get your thoughts on this too, because this story came out about a week ago that President Biden was looking at some of the pre-existing tariffs that existed from the Trump era. And the discussion is obviously to roll back some of those tariffs. And I'm curious from your perspective, would that have an impact, a meaningful impact on easing sort of global inflation issues?
Right. So, I mean, I have seen the reports, and the reports suggest that the rollback might be limited. So to put things in perspective, U.S. imports about $500 billion worth of goods from China, and maybe 300 to 400 of those are subject to tariffs from the Trump administration, ranging from 10 to 25%. And the talk I've seen is easing tariffs selectively on maybe 10 to 20 billion worth of goods. So that doesn't sound like much. Janet Yellen said sometime in June that they will be strategic, trying to roll back tariffs on goods where research shows American consumers were paying the most of the tariff. And I doubt it's going to have a significant impact on inflation, mostly because it's going to be fighting the inflation drivers of the past, which is goods. What I expect to be driving inflation going forward is services, and more specifically, household services, and housing, and the price of shelter. And rolling back tariffs on select goods from China is probably not going to do much for service inflation.
Yeah, it's obviously a complicated scenario. Thank you for helping us to dive into this.
Thanks for having me.
Daniil Manaenkov, thank you very much.